We are very attuned and very hands-on in our approach. We've been able to, in those markets, eke out a average IRR on a four to 5 year hold of 29%, and about a 2.6 multiple. So while it's a conservative approach, we're getting very, very strong returns because we're very cautious and hands-on in our execution. We really do take it seriously when we look for our projects that have upside. We're not, a lot of folks will say, "Oh, you switch out a light fixture, and that's, you can get $100 for that." We call BS on that. We know what people are willing to pay for, and we know what they're not willing to pay for, and sometimes people conflate market rent growth with something they've done physically to the asset. We've done things like add washer and dryers to the units. We've done things like reconfigure kitchens from the old galley style kitchen to an L-shaped kitchen that really opens it up. We've catered to our demography a bit by creating some spaces that the population in Fremont, for instance, would appreciate. There's a lot of Asian employees, Indian, descent, and they have certain needs, certain family, requirements for their units, and we really do cater to that population. We have other assets that are sort of in a more military type atmosphere, and we lean in on that. We make sure that we know people's commanding officers, and so when they leave their unit with damage, we let the commanding officer know, and that brings some more revenue in because they have to come back and actually fix and cure stuff. There's just a little nuances that are tricks of the trade that we deploy, being hands-on operator and knowing our markets.
So when the market's not insane the way it's been the last couple of years, although on the coast, maybe not as much on a percentage basis, not on the West Coast, what percent of rent increases are you getting? Because what I'm hearing you're repositioning these buildings, sometimes structurally even, to be just really smart about what the tenants want. And so I guess my question is those are the numbers, 29% average IRR are fantastic. So what kind of rent increases then are you getting on a percentage basis? And granted, you're in different markets, but just general color on that.
Yeah, so we're getting on lease trade outs. So somebody gives notice. First of all, we don't force vacancy in any of our assets. We just don't really believe in it. We think that everybody needs a place to live, and we can generally afford to keep somebody in with appropriate market level rate increases on renewal, which I'll tell you about in a second. But if somebody does move out, generally speaking, lately we've been seeing $300 to $400 trade out numbers. So somebody was paying $1,500, now the new resident's paying $1,900 after we've done our work to the unit. Some of that is this sort of inflationary kind of area that we've been operating in for the last 6 months. But about half of it, I would say about $200 to $250 is kind of our long time average for a lease trade out. So a new unit, a new renter coming in on something we just renovated. And then on renewals, we're of course governed by the state of California's caps. So we have CPI plus 10%. CPI plus 5 or 6% or whatever it is. It's roughly 10% today in total. And so that's what we're achieving on renewals. So as it works out, it's roughly $100 on a lot of our properties. So call it $100 on a renewal and $400 on a brand new unit. And that kind of holds for pretty much everywhere including Greater Seattle all the way down to the Inland Empire.